All right, if you've glanced at your portfolio recently, you've probably felt that sinking feeling. Yeah, the market is slipping and it's happening fast. So what is really going on behind the numbers? Well, today we're going to put on our detective hats and investigate the 3 key clues that explain this sudden downturn. You know that sinking feeling? There's actually a name for it going around, a struggle session. And honestly, that just perfectly captures the mood right now. After a pretty long run of easy gains, things are grinding to a halt, and it feels like the hard part is just beginning. So what's causing all this anxiety? Well, the first and most obvious sign is a classic flight to safety. You're seeing money just pour out of riskier stuff like stocks and crypto and run right into safer havens like government bonds. I mean, it is the textbook move when investors get scared. But why are they so scared all of a sudden? Now that is the mystery we need to solve. Okay, our investigation begins with clue number 1. The economy itself seems to be losing steam. You know, the engine that powers all those corporate profits and market optimism? It's starting to sputter, and people are definitely noticing. Let's look at the evidence. Here's our first piece of hard evidence, job cuts. In October alone, companies announced plans to cut about 150,000 jobs. And look, that's not just a number on a screen. It's a really clear signal that corporations are battening down the hatches, getting ready for a storm. And to put that number in perspective, it was the highest number of announced job cuts for the month of October in 20 years. So yeah, this isn't some minor blip. It's a major warning flare coming from the labor market. And the evidence just keeps piling up. Another data source, one that tracks jobs through professional networking sites, actually suggested that the official jobs number for October would show a loss of about 9,000 jobs. So you have multiple streams of data all pointing in the same exact direction. The once red-hot job market is cooling off, and it's happening fast. And it's not just about jobs. You're seeing prices for things like used cars falling fast too. Now, on one hand, that sounds pretty good for inflation, right? But on the other, it also signals that consumer demand is getting weaker. And that's really the key takeaway for clue number 1. The overall picture of a slowing economy is what's putting investors on edge. Okay, let's move on to our second clue, and you'll see how this is all connected. For most of this year, a tiny handful of mega-cap tech stocks have basically held the entire market up on their shoulders. They seemed invincible. But now, all of a sudden, even these giants are starting to stumble. I mean, just look at these pullbacks. These aren't some small, speculative stocks. These are the absolute titans of the industry, the so-called magnificent few that were holding everything up. And when the generals of the market start to fall this hard and this fast, it sends a shockwave of fear all the way down through the ranks. So why are they falling? It's wild because for the most part, their earnings were spectacular. The problem wasn't the results, it was the story. This quote from our source material just nails it, the burden of extreme expectations. These stocks were priced for perfection, and then some. So when they delivered mere excellence, it just wasn't enough. The narrative had gotten way ahead of reality, and now reality is starting to catch up. And all of this brings us to our third and final clue. And this is where things get really fascinating. We're going to go under the hood of the market to look at the automated, systematic forces that can take just a little bit of fear and turn it into a full-blown market avalanche. This is Wall Street's deep game. Okay, first, we need to understand one key concept, volatility. Put simply, volatility is just how much and how fast prices are swinging around. When things are calm and predictable, volatility is low. When things get chaotic and scary, volatility spikes. You can really think of it as the market's heartbeat, or even better, its fear gauge. And right now, that gauge is flashing red. This high volatility reveals a huge psychological shift in the market. For months, everyone was driven by what you could call fear of the right tail. Basically, the fear of missing out on even more gains. Everyone was chasing the rally. Now, that has completely flipped. The new fear is being not hedged enough, which is the fear of getting absolutely wiped out by losses. And this is where the robots take over. That switch in human psychology from greed to fear, it acts like a trigger for these massive automated trading strategies. And they're programmed to react to just one thing, rising volatility. They don't care about earnings, they don't care about the economy, they just follow the rules. So here's a perfect example of how some of the biggest players work. They're called volatility control funds, and their logic is brutally simple. Step 1, market volatility, our fear gauge, spikes up. Step 2, this trips a wire in their algorithm. And step 3, the fund automatically, mechanically sells stocks to lower its risk.
It's not a person making a choice, it's a completely pre-programmed reaction.
And the scale of this is just staggering. In the last month alone, these vol control funds were forced to sell an estimated $117.8 billion worth of stocks. Think about that. This isn't strategic selling based on fundamentals. It's a massive automated wave of selling driven purely by that fear gauge. And if that wasn't enough, there's another force out there that's basically pouring gasoline on the fire. It's got a crazy name, synthetic negative gamma. But all you need to know is that it's an accelerant. It comes from funds that are built to automatically sell more when the market is already falling and buy more when it's rising. It just amplifies whatever is already happening. And the size of this accelerant effect right now is enormous. For every single 1% drop in the market, these funds are mechanically forced to sell around $7 billion worth of stock. Just think about that for a second. A modest down day automatically triggers a multi-billion-dollar wave of forced selling, which then pushes the market down even further, and that can trigger, you guessed it, more selling. It's a really vicious cycle. So let's put it all together. We've got our three clues: a slowing economy, the tech giants are faltering, and these powerful automated selling machines are kicking into high gear. This brings all the evidence together and leaves us with one big, crucial question. You see, for years, the market has operated on a really simple mantra, and this captures it perfectly. Buy the spot dip, sell the vol rip. What that means is every single time the market dipped, you bought it. Every time fear or volatility spiked up, you bet against it, assuming things would calm back down. And this strategy has worked again and again and again. And that leaves us right here at the ultimate crossroads. Is the old habit going to win out? Are traders just going to see this as another dip to buy, leading to a quick reflex rally? Or is the combination of a weakening economy and this immense pressure from systematic selling funds just too much to overcome this time, leading to a much deeper slide? The clues are all on the table, but the conclusion to this mystery, well, it has yet to be written,